Good day, and welcome to the Investing Wise Academy. Your host is Fred. This segment will highlight prominent figures in the fields of investments, stocks, business, and finance. If you haven't already, subscribe now because the Investing Wise Academy will share strategies and tips that will benefit you. Let's get started. Cathie Wood manages almost $20 billion and has quickly recognized the pain that the world is about to face. China's entire economy is on the verge of collapsing, triggering the world's largest recession. China's recent economic data has revealed the country's serious weaknesses. US GDP growth outpaced China's for the first time in almost 5 decades. The Communist Party of China is attempting to save the economy, but the truth has already surfaced. This video will focus on Cathie Wood's point of view and will explain China's perilous situation. China's economy began to open up in 1978, and the country experienced unprecedented growth. China's GDP increased at a rate of around 10% per year on average. This resulted in significant prosperity for Chinese citizens. Over 800 million people have been lifted from poverty. Healthcare has vastly improved. Education has become a priority, and technological advancement has accelerated. China's unrivaled growth has transformed the country into a manufacturing powerhouse revered by economists around the world. But, as we all know, there's no such thing as a free lunch. The growing liabilities of China were the driving force behind its unprecedented prosperity. Those who took out loans saw their net worth increase quickly when the economy was booming. This encouraged others to follow suit, resulting in even faster economic growth. As a result, more Chinese people are taking out loans. The cycle acted as a positive feedback loop, causing China's growth to be exponential. This model has worked for decades, but China's debt has reached an unsustainable level. China's government debt to GDP ratio has risen to over 66%, a result of decades of rapid growth. The total public debt in China has also increased to over 300% of GDP. This is nearly 60% higher than the global debt to GDP ratio and nearly double the non-financial corporate debt to GDP ratio in the United States. Such a large amount of debt is unsustainable, as China's recent problems demonstrate. China has been attempting to implement a policy known as Zero COVID. The Zero COVID policy sets a simple goal for China's government: zero COVID cases. The only way to come close to achieving this goal is to impose strict regulations with serious economic consequences. Due to strict COVID regulations, banks and economists around the world have consistently cut their GDP forecasts for China. More importantly, China's crackdown on over-leveraged firms may trigger the polar opposite of the positive feedback loop we discussed earlier, a negative feedback loop. The economy slows as a result of people defaulting on their loans. This causes more people to default, further slowing the economy. President Xi has a simple goal of promoting common prosperity and has been enacting a slew of regulations to that end. Real estate is one of these industries. Real estate prices are the pinnacle of unusual wealth. Rising property prices have resulted in a disproportionate amount of capital appreciation for speculators. President Xi is taking steps to combat this by enacting new property taxes. The 3 Red Lines policy is another policy that Xi has implemented to crack down on real estate. The 3 Red Lines set a limit on how much debt real estate developers can take on. All of these policies have resulted in a rapid drop in housing prices. The number of new home sales is also on a decline. In 23 major Chinese cities, new home sales are down 33% in early May 2022. Because real estate accounts for 25% of China's GDP, a 33% drop in home sales would result in a 9% drop in the country's GDP. China's government is well aware of the country's impending disaster and is doing everything possible to prevent it, while the US Federal Reserve raises interest rates, the China government lowers interest rates to save its economy. The prime rate on household and corporate loans in China is currently 3.7%. This number is only expected to decrease in the future. The country's 5-year loan prime rate was recently cut by the most since 2019. Most investors regard this crash as a one-off event that will have no bearing on other countries. Contrary to popular belief, China's economic collapse could plunge the entire world into recession. The U.S. Federal Reserve is raising interest rates, boosting the dollar's purchasing power. This has a direct impact on the Chinese yuan's value against the U.S. dollar. China's currency is weakening, lowering its purchasing power at a time when the Chinese economy is already collapsing. According to Cathie, the Fed is really focused on the US, but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well, which has an impact on the rest of Asia. So what they're facing is a recession and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down. But it also means that some of them are tightening more because their currency are falling against the dollar. So it's a bit of a vicious cycle. We are not alone. Many people are thinking about the US in isolation. We've already had 1 quarter of negative GDP, which most people brushed aside saying, "Oh, that's a fluke." And I think that was a real number and we should not dismiss it. In 2021, China accounted for more than 18% of the global GDP. As a result, a sudden collapse in China's economy would weaken the global economy. Add in the fact that Europe's economic growth is slowing, and we have a frightening situation. Cathie likened raising interest rates by the Federal Reserve to playing with fire because it could exacerbate international issues. For the first time since 2019, the US bond curve inverted, signaling the possibility of a recession. When the yield on a 10-year Treasury bond is lower than the yield on a 2-year Treasury bond, the yield curve is inverted. When the interest rate for a shorter period is higher than the interest rate for a longer period, the near-term risk is higher. The Feds appear to be playing with fire, Cathie wrote on Twitter. International economies are currently extremely fragile, and a collapse in the US economy would send every other economy into uncontrollable chaos. Let's hear what Cathie wants to say about the situation.
Europe's probably in recession. China is, if we're looking at the micro numbers, China's very weak, very, very weak. And so everything's riding on the US. So the supply shocks, I think, are hurting purchasing power, as I said, in the US, could cause a recession. That will unwind the supply chain bottlenecks pretty quickly. And I think a lot of what we're seeing right now is a function of supply chain and supply shocks. Very cyclical as well. And I think we'll see the other side of that.
The last global recession occurred in 2008, and it affected a wide range of countries. The 2008 recession, however, was not on the same scale as our current crisis. During the global recession of 2008, China's GDP was still growing in double digits. The rest of Asia, Australia, and Africa did not see significant drops in their respective GDPs. Unlike 2008, the majority of Asia, Europe, South Africa, Australia, and America is currently suffering. China has a reputation for fabricating economic data to hide economic disasters and exaggerate growth. This type of reporting could indicate that China is in recession, but we're not aware of it. Cathie believes that if we saw the real numbers in China, property sales would plummet even more dramatically. In the short term, she believes this will lead to lower oil prices. Cathie also said, "I'm beginning to think that substitution as well as a recession in Europe, a significant slowdown in China. I think if we saw the real numbers there, we'd probably be seeing more declines, given how much they've hit their property sector and are bearing down on the economy generally from a regulatory point of view. So we think that demand is falling and would not be surprised at the end of the day to learn that 130 was the peak. Of course, anything's possible now, given the kind of shocks we've been through. So, with all of this knowledge, how can investors prepare their portfolios to weather the storm? Holding cash is one simple way to stay afloat, but inflation will eat away at your savings. International investing is also not an option, with Asia and Europe both suffering. Investing in the US market is one way to protect your portfolio in the coming months. Although it may appear counterintuitive, the US financial markets remain in the best shape among global markets. Although the US dollar is experiencing significant inflation, it remains relatively strong. The dollar index measures the dollar's strength against other currencies. Despite massive inflation, this index has been on the rise for the past year. Although a significant slowdown in inflation could cause gold prices to fall, investing in gold could be a great hedge. The point is that all assets have disadvantages. Diversification in the best assets would be the best option for lowering volatility while maintaining positive returns in this environment. 25% in cash, 5% in gold, 5% in Bitcoin, 40% in ETFs, and 25% in individual stocks could be an example of diversification. This portfolio may not produce the best results.
The dollar is moving up, and I do believe there's a terms of trade reason for it. China's become more hostile to capital. Europe's in recession and on the border of a war. And the US just seems like a safer place to be right now.
Do you believe the US will be targeted alongside China? Let us know your opinion in the comment section below. Thank you for watching. I'm Fred. Your segment host will highlight prominent figures in the fields of investments, stocks, business, and finance. If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.